In this video, we're going to walk through Handout 9-4 and prepare a depreciation schedule using the declining balance method. In our first example, we're going to use what is referred to as our double declining balance method. In other words, 200% of our straight line rate. Let's go ahead and see how that rate is calculated. Again, we've got a machine that costs $50,000, an estimated salvage value of $5,000, and a useful life of 5 years. So we want to take this $45,000 cost and spread it out over a 5-year period. These are referred to as accelerated methods because they go faster than our normal straight line rate. To calculate our rate, our double declining method is twice our straight line rate. And our straight line rate really would simply be 1 over our estimated useful life. If we've got a 5-year life, that would be what, 20% per year? 1/5 of the assets cost every year? While our double declining, or 200% method, is twice that. So instead of 20% per year, we're going to take a depreciation rate of 40% per year. Now, one important difference is, in our declining balance method, the amount we take in depreciation expense declines over time. We are always going to take 40% of our prior year's ending carrying value. So our depreciation expense that first year will be 40% times the $50,000, the carrying value from the prior year. Our accumulated depreciation is $20,000, which gives us a new carrying value of $30,000. Now notice, our depreciation expense in year 2 is again 40%, our rate, multiplied by the $30,000 net carrying value from the prior year. So 40% times 30,000 gives us our annual depreciation expense. And we want to be sure, again, always never depreciate below salvage value. Our accumulated depreciation expense now goes up to $32,000. Our carrying value goes down to $18,000. So in year 3, our expense will be 40% times the $18,000 net book value or carrying value, $7,200. Our accumulated depreciation goes up to $39,200. Our carrying value goes down to $10,800. In year 4, 40% of that $10,800 is $4,320. Our accumulated depreciation would go down to $43,520, giving us a carrying value of $6,840. Our depreciation expense in year 5, we're going to need to be careful. We want to limit it to $1,480. How do we know that? We've got a $6,480 carrying value. Our estimated salvage is 5. The difference between these two numbers is $1,480. If we took 40% of the $10,800, we would take $2,592 in depreciation expense. And if we do that, we would depreciate below our salvage value, $2,592. Our accumulated depreciation expense would be $43 plus the $2,592. That takes us to $46. Our net carrying value would be the $50,000 minus the $46. Notice, that's below our estimated salvage value. So we can't take that much depreciation expense in that last year. It's limited to $1,480. That way we depreciate it exactly to our estimated salvage value. We're going to walk through that same asset, but now instead of using the double declining or 200% declining balance method, we're going to use the 150% declining balance method. That simply means we're going to take our straight line rate, and instead of multiplying it by 2, we multiply it by 1.5. Again, a 5-year asset life, 1 over 5 would be normally 20% per year. 1.5 times 20% is 30%. So we'll take 30% every year. If this had been a 4-year asset, our straight line rate would be 1 over 4 or 25%. If it was a 3-year asset, 1 over 3, our straight line rate would be 33%. So we calculate that straight line rate, and for the 150% declining balance method, we multiply it by 150% or 1.5. Our depreciation expense then, the first year, again, that's the 30% times 50,000 is 15. Our accumulated depreciation is 15, and our net carrying value is 35. For the next year's depreciation expense, we take this $35,000 carrying value, multiply it by 30%, and that gives us $10,500. Our accumulated depreciation is $25,500. That's the 10.5 plus the 15. And our net carrying value goes down to $24,500. Our expense in the next year will be the $24,500 multiplied by 30%. So our expense is $7,350. Our accumulated depreciation goes up to $32,850. That's the 7,000 plus the 25. And our net carrying value goes down to $17,150. Fourth year, we take our $17,150, multiply it by 30% to get our depreciation expense. Our depreciation expense will be $5,145. Our accumulated depreciation goes up to $37,995, and our net carrying value goes down. It's the 50 minus the $37,995 goes down to $12,005. Now, if we took 30% and multiplied it by the $12,500, we would take $3,000 in depreciation expense. But notice, if our carrying value is 12 and our estimated salvage is 10, the most we can take in depreciation expense is the difference between the $12,500 and the $10,000. So we can take $2,005 in depreciation expense. And our accumulated depreciation will be the 37 plus the 2, 40,000. And our net carrying value goes down to the 10,000 we had expected.